Hi everyone, good afternoon or good morning, wherever you are in the world. Apologies for the slight delay in getting started today. We are facing a few gremlins with technical issues today, which unfortunately is unavoidable when we're all in this still mostly virtual world. But delighted to be joining you today for our latest Artemis Live webcast, which we're holding in association with Vesttoo. Vesttoo is a technology platform that facilitates insurance-based risk transfer and investments, and you can read more about them with the links in the resources section in front of you on the screen. So today, with the help of our experts, we're going to be discussing some innovative ways to access high-frequency, low-severity life and P&C insurance-linked investments. And also we're going to talk about how this opportunity could open up the market to more investors, which obviously has benefits down the value chain as well. Now, these risk classes can offer some benefits to investors when compared to the typical fixed income bonds or dividend stocks they might be allocating to. And they could also appeal to quite a broad range of capital providers, and if structured correctly, could bring new investors into the market. And so we're going to talk about the market for insurance and reinsurance linked investments and how that's continuing to develop, with new routes becoming available to help investors access this expanding asset class, and also touch on how technology can help with that as well. So you're going to learn about innovative approaches such as pooling and asset-based collateralization as well. And we're going to talk about the technology angle and how this can enable asset managers to access new types of risk. So I'm delighted to introduce my very experienced panel today. We have Yaniv Bertele, CEO of Vesttoo. We have Sam Gaynor, co-head of the financial services practice at Altamont Capital Partners. We have Hedwige Nuyens, the managing director of the International Banking Federation, and Mattias, head of insurance solutions at Securis Investment Partners, LLP. So thank you all for joining me today. Instead of introducing each of you in depth, we're going to let the questions sort of do the talking, and our audience will get to learn more about you as we go. We've got about an hour, although we run out of the audience. You can input questions into the box in front of you at any point in this, and we'll probably get to those towards the end of the session. So to begin, I thought it would be helpful to set the scene a little bit, and we're going to discuss obviously the opportunity to expand the ILS market's investor base, democratizing access to insurance risk, and also helping to bridge funding gaps that exist within the insurance market at the same time. So I'm going to turn to Mattias from Securis Investment Partners to begin. Perhaps you could give us a bit of an overview of how investor appetite at this time is, and what opportunities you see to bring new investors into the space right now.
Yes, no, absolutely. In terms of the investor base, what we're seeing is that there is quite a lot of interest from investors, not only in conventional property cat investments, but we are also seeing the more experienced amongst our investors taking an interest in how they can access casualty risk, how they can participate in new ways in the property cat market, for example, by offering reinstatement protection. And we're also seeing enormous interest from our investors in the creation of fixed income assets that provide a high yield, yet benefit from quite a high level of security. And that type of demand we're seeing primarily for investments into intellectual property type risk. That's a market that has taken off tremendously over the past year and a half. We are also seeing a lot of interest from our investor base in offering premium finance, commission finance, etc. So there's enormous appetite from investors that are looking to pick up a nice and higher yield from investments that aren't correlated to market risk. With market risk, I mean both equity markets as well as the credit markets, and also not necessarily correlated to insurance risks that are already taken within the property cat sector.
Okay, that's really interesting, because that's quite... quite a broadening of appetite there, and also the types of risks people are looking at, which is positive for the market right now. So Yaniv, moving on to you at Vesttoo, you're helping to connect risk and capital across a broad range of perils, and I know these are the risks that Mattias mentions. Probably some of these are within scope for Vesttoo at the moment, but you've had a specific focus on the higher frequency and lower severity area of the market. Is this an area you're seeing good investor demand for at the moment, and what benefits do you think those types of risks might bring to investors versus the more typical catastrophe perils?
Sure, thank you. So I do believe that the higher frequency, low severity perils, such as motor liabilities and versus casualties, etc., always have a common ground that separates them from the catastrophe risk, which is the low volatility and projectable cash flows. We believe that the stochastic nature of those risks empowers the opportunity of utilizing technology to enable the risk transfer and educate the markets on the attachment probabilities and expected loss distribution functions that could eventually also educate partnerships such as rating agencies to enable a broader rating process of those instruments. This is particularly attractive to large asset managers, we believe. And as the market is democratized to include more capital market players, we're seeing more demand for these types of perils. Using technology and multiple data sources, both claims data as well as other sources such as inflation data, we're able to create a highly accurate forecasts for claims development. So for investors, as Mattias mentioned, this provides stable, relatively predictable risk-adjusted returns and an attractive alternative to traditional fixed income investments that are credit and market exposed, and providing the benefit from the uncorrelated nature and diversification shared with catastrophe risk. I do believe that the data-driven technologies allows us to provide full risk transparency and performance monitoring of those risk types, which are both very important to investors, effectively translating the insurance risks to something that they can better understand. And I'm fully resonating with Mattias said associated with the IP collateral protection. Vesttoo is involved in those transactions these days, along with commission protections. And we as a platform for risk transfer believe that once these transactions are also further rated by working with the market leaders and the rating agencies, we expect interest to increase even further.
And it sounds like with the analytics that you'll layer on top of transactions, you'll be providing benefits both ways to the investors and to the seeding companies as well, I imagine, Yaniv.
Correct. We see that investors that are willing to take part in the educational process of understanding the transparency, the objective nature, and the accuracy of artificial intelligence-driven transactions, while we educate them on the process, they benefit from the fact that this instrument now has an ongoing monitoring of its performance, both associated with mark-to-model or mark-to-market perspective, along with future projections as to where we believe in any given time the risk will be developing. Wrapping it down back to the insurer, an insurer transacting through us has a dashboard associated with the underwriting performance of their portfolio based on how we review the risk. And as an intermediary that doesn't generate revenues from the risk modeling rather than from transactions themselves, we benefit from providing this added value for the parties, where one, the insurer could get additional insights as of their underwriting in various states and various perils associated with how we see the risk developing over time. And on the investor side can now get a daily mark to model as to the performance and future performance of their instruments, which would put them very, very close to whatever they could do in the equity markets today.
Yeah, that's really interesting. I do think data is the key to getting into some of these different areas of the insurance market once you get outside of the less predictable catastrophe perils. So now I'm going to turn to Hedwige. Now, you represent the banking industry in our discussion today, and perhaps you could talk a little bit about the potential size of the opportunity for investors around the world here. How big a deal do you think it could be if access to insurance-linked returns were made simpler for investors and more risk was made available to them?
Yes, I think it's a very good question. And we all know that banks are loaded with deposits right now. During the COVID period, actually, the deposits, the level of deposits amongst banks grew enormously. So that means that banks are looking for the right kind of investment. And as Mattias said, rightfully, banks want to diversify these investments. So they know they have a credit risk portfolio, which is very important. They know they will have to onboard climate-related investments. So this type of investment that is insurance-related, but different from what the classical credit risks are representing or climate risk, could really be an opportunity, albeit, of course, subject to transparency, subject to what Yaniv was saying. What about the data available? What about a rating agency? So these are important things as well. But definitely, I think that there is a momentum.
Great, thank you, Hedwige. And so, Sam, turning to you now, Altamont is a private equity specialist, and you have a bit of a focus on insurance, asset management, and specialty finance businesses there. But what's your view of the ILS market as somebody who's perhaps a bit of an outsider to it? And is it something you look on favorably for traditional reinsurance businesses to have access to these new capital sources?
Yeah, most certainly. I mean, I think about it, I talk about it quite a bit with our portfolio companies. Both we own a portfolio company in the life and annuity space, Cuvert Holdings, that has quite a large balance sheet and is investing typically in fixed income securities, and then have a separate portfolio company in the commercial line space, Accelerate, and talk about it a lot with both companies because on one hand, from a ceded perspective, as owning primary insurance business, ILS capacity, I think, will be a growing component of our reinsurance stack, both given sort of the flexibility and the what should be attractive cost of capital, and on the risk-taking side, talking about it with our life insurance business, relative to where fixed income yields are today, and relative to the much more attractive risk profile that a diversified book of P&C business can have, especially within, as we've talked about in the casualty space or in the commercial line space more broadly, where there's just been less ILS penetration. It's a very logical place for expansion for the industry. And so it's something that I think should continue to grow over the coming years. And the logic is behind it. We'll talk about it later in the panel, but there's reasons why it hasn't happened thus far with duration and the like. But my hope is that over the coming years and through some of the technology that's being developed that allows for greater risk transparency, adoption will continue to broaden over the coming years.
Great, thanks, Sam. Yes, it's interesting that you mentioned the two sides there of P&C companies hedging using ILS capacity, but potentially life companies using it as a way to actually onboard diversifying sources of risk in a investable form, because that's an area that regulators around the world are currently looking at, particularly in Europe and the US, around securitization investments for life insurers. So that's potentially another growth area for the industry, and one that certainly needs the transparency and data sitting behind it, I think, to make that really work, and likely the ratings too. So we're going to move on to sort of the risk side of things. There appears to be a growing appetite to access new types of reinsurance or retrocession funding in the carrier community. And at the same time, there's some gaps in capacity appearing, especially lower down in reinsurance towers, as carriers have been moving up to avoid volatility and also influences like social inflation that have become quite concerning in some areas of the marketplace. So all of this suggests a need for more and more diverse capital sources, but also perhaps better ways of integrating them into the stack of these companies as well. So Yaniv, perhaps you could share your thoughts on where you think specific opportunities may be found for new capital providers or investors who are looking to access ILS or insurance-related returns. Where are these sort of gaps in coverage, these sort of niche areas where there's maybe a bit of stress in the market, but where investors could come in and make things easier for the underwriting side?
Thank you. Yeah, so to start with, to be honest, we see very diversified opportunities for new capital providers all across the board. On one hand, we have structured many aggregated stop-loss transactions in collaboration with traditional carriers, covering top layers of reinsurance towers where, as you mentioned, there is less volatility, but also less reward. But we're also seeing an increased need for quota share solutions lower down the tunnel. We do the tower. Sorry, we are seeing increased movement all across the board in both life and P&C. But if I would have to choose a few, we're seeing increased interest in pandemic-related hedges. Those could actually be business stop hedges measured against increased mortality. Event cancellation, we do see product liabilities, hedges required due to supply chain issues, as well as excess mortality. Longevity is becoming a growing issue, and I'll be discussing it further in a minute. But motor liabilities, homeowners, general liabilities, we did discuss collateralized IP protection, and as Mattias mentioned, the commission protection. So if I was to try and quantify this, and connecting to what Sam just said, is that we do see also life insurers, and we're discussing already and transacting with a few, buying P&C risk, seeking diversification across that board and vice versa. But we do see asset managers and real estate investors that are extremely exposed to market and credit risk, seeking to diversify some of their portfolio, but not necessarily investing cash. You know, an asset manager or a real estate investor sitting on securities could utilize those securities as collateral for those deals that we structure on the aggregated stop-loss layers, by generating excess spreads on top of their current yields without necessarily increasing their risk profile, as you are moving away from the credit and market risk into the uncorrelated nature of those diversified opportunities. So in essence, we're creating a structured alpha over those risk remote layers by utilizing current securities as collateral, generating excess spreads on top of those yields. And I would definitely come back to your question saying we see interest all across the board. The lowest hanging fruits are definitely the P&C deals, the motor claims, and the general liabilities. The growing segments on our portfolio are definitely longevity, both for reinsurers and cedents themselves.
Great, thanks, Yaniv. And that's interesting about this sort of securities lending approach to backing collateral for reinsurance deals with existing assets, because obviously that potentially speaks to a very broad range of large fixed income investors as well, who currently probably are not in the space. And I suppose a whole load of different requirements are required to get that on stream in terms of ratings, as you mentioned as well. Mattias, moving on to you at Securis, are you seeing demand from your investors for access to a broader range of risks? And what do you think is going to be sort of required to help increase demand for ILS in general, but also to get perhaps some of these different investors that Yaniv was alluding to into the space?
Yeah, sure. So I think, I mean, when the ILS market started, the big idea was essentially the buying of cat bonds and investing in cat bonds. Then the market moved on to being much more about fronted reinsurance, and that was sort of the next step in the ILS journey. Both those products are well understood by investors. They like them, but they're very much now looking for, well, what is the next step in the ILS journey? And they are very interested in conversations about how they can access new types of risks in new format. And what we call it here is at Securis, we call it to ILS, a new risk. And there's enormous demand for investors for that type of product. They're very keen on it as long as it comes to them in a sensible format. And that is to an extent what is sort of holding the market, the ILS market, back from its next stage of growth. For a market to be accessible to ILS investors, the transactions need to have shorter as well as defined maturities. And also, very importantly, the risk need to be capable of modeling. What's the big sort of mother load of premiums and liabilities within non-life insurance is the casualty sector. There we are seeing the first steps where deals are coming to market that have been structured specifically with the view to bringing in ILS capacity. Where ILS funds really struggle to participate are when deals don't have a defined maturity or a maturity that is too long. An insurer or reinsurer is very happy to sign up to a deal that might run for 40 years in the knowledge that most of the deal will have come off risk in the initial few years. But that's not possible for an ILS fund for the obvious reason that that ILS fund might not be around in 40 years' time. And so it's yeah, no, I mean, but to answer the question, yes, there's tremendous demand for investors for new and uncorrelated risk. What is holding that demand back is the lack of specific product that is accessible to ILS investors.
Great, thank you, Mattias. And that actually leads on nicely to you, Sam. I was going to ask you sort of what you feel might be needed to really open up the ILS market to more investors. Now you come from a private equity background, and obviously some private equity investors do allocate to sidecars as another way of getting an equity-like investment in a reinsurer. But thinking about what Mattias and Yaniv have been talking about, is there anything from your experience that you think would really help to sort of give this market a greater exposure to a different and larger type of investor base?
It's actually, I think they both hit it really well. If you think about what Yaniv said, I mean, there's been such a massive amount of data loss in the insurance world historically, where, you know, from the retail broker to the primary carrier to the reinsurers, the amount of data that you start with that you ultimately end up with that risk bearers can review has been a real problem. And so being able, when you think about sort of the value of a diversified portfolio and being able to very accurately model your volatility, correlation to other asset classes, assuming you're an institutional investor investing into ILS, that's being, I think, fixed over time with some of these technology platforms that are enabling people, enabling better intake up front, and then analysis along the way that can feed into more accurate modeling that ultimately will give more comfort to new capital coming into the ILS world that previously just couldn't get there with the amount of data that was available to them or the accuracy of it. And then Mattias's point is spot on, because duration certainty has been a huge issue, and it's less for us as a longer dated private equity fund, but for the industry more holistically, having legacy solutions that can sit behind ILS vehicles and become smart about the risk that they're taking I think, is part of is something that, ultimately should develop more and more, that would enable, classes that are not property cat to come in and write longer tail lines of business, but only be on them for, a period of time that sort of works for their investment mandate. So I think everything they said is spot on in those regards.
Yeah, that's interesting, Sam, as well. I think the first comment you made there about sort of data portability through the industry and down the value chain is telling, because the industry has not been particularly good at that over the years, and really it's only now that they are getting better at it. But obviously you have a very disparate marketplace with a very wide range of standards and systems involved, and it takes time to get some sort of harmony together. And while standardization is not always the answer, we do need more structure perhaps behind things to make things investable, which speaks also to Mattias's comments as well. So Hedwige, turning to you again, using your banking sector expertise, what do you think the big banks could do to help open up more investor opportunities and insurance risk? And what do you see as really critical for getting investors confident with insurance as an asset class? Hedwige, are you there? So did you hear my question? No, I think we've lost Hedwige at the moment. I was asking you, Hedwige, about what do you think the banks can do to help?
I think we have to look at the fundamental different ways banks are looking at risk. So traditionally, banks have been onboarding a lot of risk. So traditionally, banks have been, yes, banks have been onboarding risk for a long time already, isn't it? And so
maybe I can chime in, Steve.
Yes, please do, Yaniv.
When alongside Hedwige trying to get her connection better, I'd like to connect the 2 points that Sam and Mattias mentioned.
Lens. So normally when a bank looks at the risk, there are 3 questions that are asked.
Oops. So I'll connect back to the 2 points in the interim. So I think the long tail point that was raised by both is one of the major hurdles we just discovered in structuring the access to the broader capital markets, by means of understanding that a longevity risk associated with the in-payments portfolio, for instance, cannot be transferred into a 40 years derivative and placed with the capital markets, which means that in essence, we need some sort of a agreed upon commutation mechanism that would shorten the duration of the instrument for the investor, while providing compensation in the settlement period for the risk carrier, for the cedent. So we managed to prove the fact that based on, again, advanced mathematics, you could utilize the technology in order to significantly decrease the potential basis risk associated with the commutation, which means that you can now, without affecting the deal's economics, shorten even 40 years of tail into a 5-year transaction, settling after 5 years while commuting at 35 years of risk, settling and being able to measure the low impact of that commutation, which means that you can actually now not only project the risk going forward, but also commute it into a shorter duration of an instrument and place it with the broader capital markets that are not insurance savvy, nor wants the exposure of the 40 years. And I think connecting to Mattias' point associated with the lack of access, this is exactly where Vesttoo comes in. We seek to democratize the risk transfer to investors that are non-insurance savvy, being able to put in front of them, whether it's rated instruments or analytically measured and back-tested risk modeling associated with tools they are familiar with, creating a common language in between those two markets.
Great, thank you, Yaniv. And I suppose, unfortunately, I think we have lost Hedwige. She is sitting in the transport lounge for the Eurostar this afternoon, unfortunately, so her connection has not really been up to the job. But just speaking about the banks a little bit, I think Hedwige was keen to talk about the way banks can help in making products more institutionally focused, I suppose. And certainly, I think the banks have got a role to play in both helping to sort of meet this vision of the sort of securities lending type approaches, because obviously collateral and letters of credits and the like are going to be required, and banks will probably sit in between investors and transactions in those cases. But also banks are obviously very good at finding ways to bring capital efficiently into marketplaces and to help with getting ratings and the structures required around that as well. I mean, Yaniv, these are things that you've obviously spoken about with some of the banks. I know we've spoken before with some of the banking groups and yourselves. What sort of progress is being made on getting products ready for investors with their help?
So the banks, in essence, are a strong and sustainable path to the broader capital markets by, from my perspective, helping to educate the broader community of capital markets. Let's call it as affiliates, while understanding that the diversification, that risk moving from the insurance space to the capital markets, and capital markets diversifying their credit and market risk associated with those instruments, provides benefit to those two industries, fusing them closer together. So what we have in the insurance link program, which essentially is a non-cash, non-cat fund, we enable asset managers to lend their securities to us, whether you're a real estate asset manager or other asset manager, but you're a commercial partner of a bank. The bank would help you affiliate with us by lending your securities to Vesttoo, where we, under the ILP, could deploy those against specific risk remote deals that are either rated or through swap instruments, and then effectively, and without increasing the risk profile, generate excess spreads. The banks have significant analytical power to allocate teams that would understand the benefit that the long-term uncorrelated nature of those instruments would benefit the capital markets. You know, some might even speak about the regulatory arbitrage that benefits both sides. And by affiliating themselves with us, they provide a huge opportunity for their clients to get exposure to those instruments. So I think their role would be, one, to work alongside the regulators to affect the attractiveness of those asset classes to the broader capital markets, get close with additional partners in the space, like the credit rating agencies and the accounting firms, in making it accessible to their clients, but also affiliate themselves with those instrument providers, as they cannot invest in their funds themselves, by making it accessible to their customers. That sort of help, I believe, that the banks could provide. In addition, I think that in due time, even utilizing their treasuries to participate. And, you know, having individuals such as Hedwige with her legacy and experience in the capital markets, driving the regulation and the public domain towards more and more exposure to insurance risk, speaks for itself.
Great, thank you, Yaniv. I just wanted to check whether Hedwige has managed to dial in on her phone, because
yes, I'm there, Steve.
Thank you. Good. Thank you for confirming that. So I'll go to you then, Hedwige. I was asking sort of what you feel banks can do to help open up, and what support can they provide to the ILS market, and do you think there are ways that the capital markets and banks in particular can help to further develop ILS and drive opportunities for new investors?
Yes, I think that's a very good question. And I was struck by what Yaniv was saying just before. I think it's important to explain that the banking risk and the insurance risk are quite opposite, or you could say complementary, where in the insurance business you get a fee first and then you take on the risk. It's opposite in banking world. The banking modelers are used to work with the probability of default, the loss given default, and the exposure at default. And so I think if banks want to take on more of those insurance-related risks, they really have to evolve in their modeling teams. And Yaniv is completely right. They have the modelers, but you have to take on new expertise and better understand how the other products you want to onboard work precisely. So it's all about understanding the risk, adapting your models, and also what Sam was saying, looking with regulators what will be the risk-weighted assets, because that's key. No bank will take on investments or products if they do not understand precisely what the risk-weighted assets will be. So that's still an open question.
Great, thank you, Hedwige. So Mattias, moving on to you, do you think the additional features such as ratings are going to be beneficial going forwards for the ILS market? Do you think this is something that's potentially key to really open up to a broader range of investors? And are there any other sort of features of securities that perhaps the ILS market should be looking at going forwards?
Sure. No, so I think in terms of assigning a rate of ILS instruments being rated, that does open up a whole different universe of investable capital. As Hedwige was alluding to, for banks to be able to invest in ILS, they absolutely need a rating of the instrument in order to compute the risk-weighted assets. There's also a lot of large institutional investors that have constraints within their mandates that say we do not invest in anything that's either not rated or rated below a certain level. So in terms of rating bonds, notes, and securitizations, that does open up a whole new and different universe of potential investors. And those will be investors that don't want to invest through ILS funds. From the perspective of an ILS fund, a rating does not make much difference. We always do our own due diligence on the transactions, and our reply when somebody asks, does a rating make a difference to you? We always say, no, we'd rather you pay that money across to us instead. The other thing that will make...
Sorry, I was just going to say that does make perfect sense, because really the ILS funds are far more expert at analysing catastrophe risk than any rating agency really can be at this point in time.
Absolutely. And once you sort of go into the more conventional asset classes like ABS, etc., a lot of transactions there are structured with a specific rating in mind, and the rating agencies are fairly prescriptive in terms of how they model risks and what the criteria are to achieve a certain rating. And there's a lot of gaming of the system going on, in particular in the ABS market there by banks. In terms of the other thing that will make a massive difference to the investor universe into insurance risk, that is more liquidity in the market. Lots of investments, in particular sort of private investments that we make, have absolutely no liquidity whatsoever. That stops a lot of people from investing in these transactions, because they require an up-to-date mark-to-market value every day. and they also require the ability to exit the position if they choose to, sometimes on the same day. So that becomes a bit of a chicken and an egg problem, because as the market grows, more liquidity naturally comes in. However, in order for the market to grow, more liquidity is needed. And those to my mind, are the two big things that are needed in order for new investors to come into the ILS market and, for lack of a better word, have a go on their own.
And I suppose in time, if the ILS market is going to expand in a more institutional manner to begin with, that often does result in opportunities cascading down to the more retail or at least high net worth level via the banks as well. So perhaps that's a future development that we could see too. I know we already see money from that marketplace coming into UCITS funds and mutual funds and the like, but perhaps that would also be likely to expand with more bank participation. Sam, turning to you.
So Steve, do you mind if I just make one observation on bank participation? In terms of bank participation, I don't anticipate that the banks will be buying ILS for their own balance sheet. Instead, where I would think banks would participate is in terms of sourcing high yield assets for ultra high net worth clients within their private banks. That was the only observation I wanted to make. Sorry.
Yeah, no, I would agree. I don't think they want to invest and hold themselves, but they will probably take on assets, possibly restructure, and then create solutions for their clients to allocate to those, which could be interesting. So Sam, moving on to you. So insurance-linked returns sort of fit your profile at Altamont on the private equity side, and you invest in the sector. But do you think the return profile of a more direct allocation into insurance risk through ILS could also become more appealing to private equity and maybe other types of investors as well?
Yeah, it's certainly something we've considered thinking about in the future, and I know that there's other private equity or private investment firms that have raised funds to do it, or are finding ways to put it into yield-oriented vehicles that they typically had otherwise devoted to private credit or the like, or preferred equity investments. And so it's something that I would imagine will get additional hold over time. I think everybody who, like us, who invests in the insurance world understands the potential arbitrage that exists between regulatory irrationality, if you will, where regulators both on the P&C and on the life side, require you to hold capital and reserves that are well in excess of any economic probability that would exist that you would actually need those reserves. And from a capital efficiency perspective, it's always going to make sense for insurance companies to find solutions to pay reinsurers, or in the future ILS funds, in order to take those reserves off of their own balance sheet or lessen the capital strain. And I would imagine that private equity funds will be one of hopefully a few different participants that come in to be part of that solution, because the risk return profile could be really attractive.
Great, thank you, Sam. And I know also that investment companies in your part of the world, in California, are also very interested on obviously the venture side, and we're seeing quite a lot of interest from some of the bigger VC funds in ILS, and interestingly also from some of the partners of some of the big VC funds in California as well, who are looking at catastrophe bonds as an ESG asset for their own family offices, which is an interesting development these days. So one of the topics we've sort of been discussing here today is about new ways to enable larger investors to participate in insurance markets, but also without them needing to necessarily use cash to directly collateralize risks, and rather pledging their own highly rated assets as a way to enter this marketplace. And this approach of pledging securities as collateral is quite common in some other asset classes, but much less so in ILS and reinsurance. Perhaps something we should be thinking about, and something we could see more of in the future as a way to absorb some of the additional capital market appetite, which obviously is in excess all of the time these days, while also directing that capital to some of these funding gaps that exist. And Yaniv, obviously this is an area of specific focus for you at Vesttoo, and perhaps you could give our viewers an overview of the insurance-linked program that you've developed.
Sure, thank you. And I think the ILP, the insurance-linked program, comes as an understanding that the bigger you go in the investors you target, going to the qualified institutional investors, the pension schemes, you need to provide investment opportunities that would not necessarily need a investment committee on a per deal basis. So you need to structure something that is similar to an ILS fund, but then again opens up the abilities to utilize the asset managers' securities by generating excess spreads and not investing those in catastrophe exogenic type of risk, rather focusing on the more risk remote, measurable, high frequency, low severity. So we are extremely excited about structuring the ILP. It is a very similar fund structure that is offering a security-based participation based both on life and P&C exposures, but there's no cat exposure. The institutional investors are provided with the opportunity to earn additional long-term sustainable alpha from existing assets without the need to allocate cash. So while these types of structures are not common in the financial market, it is the first in the ILS sector. So the ILP program offers institutional investors risk remote investments in collateralized reinsurance deals covering perils that we mentioned earlier. We're confident that, and we are reaching BB spreads over AA uncorrelated risk in addition to the yield of their existing high quality assets, T-bonds and others. With a significant global deal pipeline, we are about to cross the $1 billion US dollars transfer through Vesttoo, and now going over to a more asset manager type of business model alongside with structuring the deals during this month. So this is a unique opportunity as investors don't need to directly allocate cash. And the fund structure, as well as the technologies we used, almost removes the risk entirely by aggregating several deals together over a portfolio of investors that are already participating in the deal, getting them additional 100 to 300 basis points per annum over their current yields of their existing assets. So we have a significant amount of participants already, and this trend is growing beyond, again, the per deal basis. So I think the go-to-market from our end is to focus on the long term, bringing in the large asset managers, the pension schemes, the qualified institutional investors, while as quick movers enable asset managers, mutual funds, private equity firms, even large family office to lend, even for a short period of time, their securities by pledging them through a swap, for instance, to some of our portfolio deals. We are using those as collateral for the risk remote opportunities, and the investor gets an excess spread on top of their current yield without necessarily increasing their risk profile. And I think that in turn can become very appealing for asset managers, even in the real estate business. In other areas which they seek exposure over the current assets in order to generate excess spreads.
Thanks, Yaniv. I would think for any investor who holds a lot of highly rated assets, it must be quite an attractive proposition to be able to make those work harder for them. Now, I would imagine that this is very technical under the hood, how this is actually put together. But Hedwige, perhaps you could explain. Sort of, do you feel this is something that would be particularly attractive to the world's largest investors, and what is the sort of role of the banks in facilitating this?
Yes, I think it's right. So we have increasingly large investors that have large amounts of high quality assets and are very eager to get additional yield on this, and so to make it work and to increase the return on investment for their own shareholders. I think the role of banks could be in a kind of second opinion, because of course we are talking about highly innovative products, even though I think the most attractive will be the ones with lots of data, so high probability, so high frequency, low severity, so what we were talking about in the beginning. I think those products with large lots of data where you can have a predictability there, I think banks will be willing to endorse and to give a positive opinion so that investors feel more confident to move on. I think there is a second role that it could potentially play, and that is precisely because what Yaniv is saying is so innovative. It could also be taken on as a kind of extension of the portfolio, because we really need to invest and to try out new forms of investment and hedging as we move to a quite different world post-COVID and pre-climate change operations. So large investors are really looking at new products and new hedge possibilities to cover those risks.
Thank you, Hedwige. And that's actually a very good point, that investors, the larger investors who are also some of the world's sort of strongest appetite ESG allocators, may find it appealing to be able to pledge certain assets and invest in something that has perhaps higher ESG qualities as well, which certain types of insurance risk could be deemed to have. So that could be a very interesting development, perhaps, for the market moving forwards. Moving on to you, Sam, might this type of approach be something appealing to Altamont, do you feel, or other private equity funds? And this would allow you to make use of sort of lower risk, highly rated assets to tap into something that's relatively uncorrelated. Do you think this is a approach that is going to get some traction with the big investors of the world?
I do. I mean, there's a huge amount of, when you think about the spreads that exist right now between traditional fixed income securities, even higher yielding securities, and what is available from a return on capital perspective within ILS vehicles, it makes a ton of sense, right? You get a lot more yield for taking the same amount or even less risk. And I think to some of the points that Yaniv was making, it's really important, but both on the data transparency side, but also on the diversification side, that you're able to get that right and construct it within pools that become highly, highly predictable over time. Because the one worry I would have would be that when you have, pools that are overweight to, think of it, a given claim, a given cedent, any one given event that could create systematic risk within the portfolio, and you develop lumpy results, that's a little bit harder to stomach for private investment funds, especially in private equity, that are promising to their investors stability and predictability to returns. And so I think there's a huge amount of value that can come, assuming that we're able as an industry to both get a large amount of uncorrelated risk into a portfolio, and any one of which would not be able to swing the ultimate result, and do that in a way that where it's sort of nicely modeled with the data that we talked about, that would be coming through the through the pipes and can provide sort of accurate predictability. So I do think in some that it's something that should become increasingly popular in the private equity world over the coming years.
Thanks, Sam. That's some good points there about the need for these to be deep, particularly deep pools of risk, I suppose, and particularly diverse across individual claims, because yes, they need to be sort of, while they might be higher frequency in terms of the claims, they need to be lower volatility so that investors are feeling more comfortable about the slow attrition rather than the large peak peril type loss events that might affect those portfolios. So finally, moving to you, Mattias, what's your view of this sort of method of accepting assets into the industry? It's obviously very different to how a traditional ILS fund manager might work, but do you feel this could be a way to broaden the appeal of the market and onboard new investors into the space?
No, absolutely. I mean, speaking sort of from my own narrow self-interest, we always sort of recommend that investors don't invest directly into individual securities, but rather that they appoint an ILS fund, such as ourselves, to construct an optimal portfolio for them. From our point of view, taking a step back and going back to investment banking, which was sort of my earlier career before going into an ILS fund, the most important thing to be able to place insurance risk with a very wide panel of investors instead of specialized investors is to create an asset, firstly, that's easy for the buyer to book, to custody, to value, and to sell. So if we, for example, look at the market for mortgage-backed securities, that started years and years and years ago, and now it's moved into something that's much more standardized, and it's a deep and liquid market. People are able to access 30-year deals, 30-year financing, but the reason for that is that the investor in a 30-year deal has confidence that if he needs to convert the asset into cash, he can easily find a buyer for it without having to cross very wide bid-ask spreads. So those would be my thoughts on that, Steve.
Okay, thank you, Mattias. I appreciate it. So we're kind of just about to run over time, but given we've had some technical issues, we will try and take a couple of the audience questions. Now, we've actually got quite a few that have come in, so we're not going to have time to answer them all today, but what I will do is I'll distribute them to people who might be able to answer, and we'll have your email addresses, and if we can, we'll try and get back to you with a response at least. So the first question, which was actually the very first one to come in, and Yaniv, this is for you. It came in earlier on when you were talking about sort of the artificial intelligence models and indices that you create at Vesttoo, and someone was asking whether you backtest those models, sort of how you validate them against what sort of data sources are you using, that type of thing. So maybe you could just talk about that a little bit.
Yeah, so that's an excellent question. That's the great benefit of working with artificial intelligence technology as the underwriting. One, you get an objective, diligent process that structures the expected loss distribution functions out of the raw data. So to start with, you have a non-expert judgment that results in a result that could be measured. So measuring the accuracy of the results, yes, is done by significant backtesting, by similar means as the capital markets are familiar with. And that, again, is one of the legacy points that we bring to the table in utilizing capital markets methodologies to make the insurance risk understandable by creating this common language. So yes, we backtest the methodologies, we backtest the portfolio results, and we backtest the algorithms to the extent that we sometimes can even go back, so to speak, in the past, structure the deal as if the portfolio was in 2015 and proving that the current 2021 portfolio results are what would have been projected by the model by a certain deviation. And that deviation is measurable, which in turn could quantify the accuracy of the model. So there are a lot more details to go along with it, but yes, the accuracy of the model is totally measurable, and backtesting is definitely something we're fully engaged with.
Great, thank you, Yaniv. So given time, we'll just take one more of the questions that came in. And again, this is something from earlier in the session, and this one's for Mattias. You mentioned commission protection as an area of interest in ILS at the moment, that it's somewhere that transactions are sort of becoming a little more frequent, or at least maybe a little more interesting? And somebody's asked, could you just explain a little bit more about that, please?
Sure. In terms of what Securis does within commission protection and commission financing, is that we very often we find that in particular sort of high growth MGAs very quickly build up large balances of receivables from a number of insurers and reinsurers. And basically how that balance builds up is that they invoice them for the commission, and then about 60 to 90 days later, they're actually paid the commission. As they grow their business, at the same time, the receivable also grows in size. So we find quite a good set of opportunities for us to lend money to MGAs secured against the commission payments due from insurers and reinsurers. So that's what we think of as commission financing. In terms of pure commission protection, there we have not done anything as yet. We've had some very interesting conversations with Yaniv on that particular product, but we've not yet done a deal. So I think it's probably Yaniv who's best placed to talk about commission protection rather than me.
Sure. Thank you, Mattias. Perhaps Yaniv, have you got anything to add then?
Yeah, so I think commission protection are deals that we structured. Commission protection is a line of business that makes significant sense for the intermediaries and the agents, the brokers industry. I think as the commission is slightly tied back to the GWP, the ULR, the sliding scales, those are stochastically measurable against the industry, specifically in that specific portfolio benchmarked against the industry. So that in turn possess an opportunity to classify those types of transactions within the low severity, high frequency type of transactions, which are totally measurable and have been structured and have been placed with the broader capital market players by Vesttoo.
Okay, great. Thank you. So I think we're going to draw things to a close there. As I said, we have got quite a few more questions that came in, and I am going to direct them to the best people to answer them. So hopefully you will hear something from our speakers by email, because we will have your contact details from having registered for this. If you dialed in halfway through, you will be able to watch the whole thing on demand later, and you can share that link with your colleagues if they want to watch as well. So thank you all for tuning in. Really appreciate it. So finally, I'd just like to thank our speakers for their time today. Thank you, Yaniv. Thank you, Sam. Thank you, Hedwige. I'm glad you could join us, even though we missed not having your picture. And thank you also, Mattias, as well. I really appreciate all of your intelligence and insight that you've shared, and your time taking part in this today. So thank you, everyone. We'll be back with another of these next month, I believe. So I look forward to talking to you all then.
Thank you very much.
Thank you, Steve.
Thank you, Steve.
Thank you. Thank you.